Hello, this is Emily Costa and welcome to the Commodities Institute podcast. Today is December 5th, 2025, and you're listening to a fresh episode where we pull apart the market movements that matter, not the noise, but the threads that will tug at prices over the coming months. I'm going to walk you through metals, carbon and power, agriculture, oil and dry freight, in that order, and explain what's happening, why it matters, and who's most exposed. Let's start with metals. The conversation around critical minerals and base metals is becoming increasingly political and strategic. Executives at recent industry forums have been blunt. Washington has to move from funding and pilots to an industrial plan that stitches mines, refiners, and end users together. One striking point raised was nickel. Indonesia now supplies roughly 60% of the world's nickel raw material. That surge has pushed nickel prices down nearly 50% from earlier highs and has shuttered some projects. Private refiners in the United States are arguing for policy levers, quotas, or pressure on Indonesian output, because a sudden rebalancing of supply could, in theory, lift prices overnight and make US projects viable. That's not a market solution so much as a geopolitical one, but it tells you how strategic these metals have become. Rare earths are in a different bucket. The market is much smaller, largely opaque, and price discovery remains immature outside China. Industry leaders want transparent pricing mechanisms, even to the point of nudging exchanges to develop benchmarks, because you cannot build supply chains for magnets and batteries on guesswork. The practical consequence for listeners is this. When a country speaks of securing supply, they're talking about long lead times, policy risk, and potentially subsidized state interventions that will affect costs for electronics, EVs, and defense supply chains for years. Moving to carbon and power, the LNG picture is sharpening into a story about margins. US Henry Hub prices spiked above $5 per million British thermal units recently, as cold weather and higher feedstock demand squeezed domestic supply. At the same time, an abundance of global LNG, much of it shipped from the United States itself, has pushed prices in Europe and Asia lower. When the spread between Henry Hub and European TTF prices narrows, the profit margin for US LNG exporters evaporates. We're already seeing that with spot revenues compressed and the spread at its slimmest since spring of 2021. Analysts warn that if that spread tightens further, some export volumes could become uneconomic, particularly once production costs are taken into account. Add the political overlay, pledges to keep domestic energy cheap, changing support for renewables, and you get a market that could tighten at home even as it floods abroad. On the project front, Chevron's Gorgon project in Australia just cleared a major $3 billion investment for a Stage 3 development that will backfill existing LNG infrastructure and secure both export tonnage and domestic gas supply for Western Australia. That's a reminder that companies are still investing where long-term contracts and domestic policy align. Now agriculture, where supply dynamics are mixing a few surprises. Brazil's soybean exports jumped dramatically in November, a surge of 64% year on year, as an exceptionally large crop and strong logistics kept vessels moving even as Chinese buying patterns shift under the US-China trade deal. Brazil moved roughly 4.2 million metric tons in November alone, and the pipeline looks robust into December. Corn in Brazil, though, tells a different story. Domestic demand for ethanol and feed has pushed some analysts to trim export expectations for the year. The headline for producers and processors is simple. Ample soy supplies and strong shipments will pressure global meal prices, while corn availability will be more regionally constrained. North of the equator, Canada surprised markets with bigger than expected canola and wheat crops. Canola production came in at 21.8 million metric tons, and all wheat near 40 million tons, both above trade expectations. Those numbers matter because Canada is a leading exporter of canola and a major wheat supplier. The immediate market response is downward pressure on futures. One analyst suggested canola could slip below $600 Canadian per tonne if the futures curve has to clear excess stocks. For end users, this is relief on oilseed availability and feedstock costs, but for farmers, it's a signal that margins could compress unless global demand picks up or logistics tighten. Turning to oil, and we'll circle back to how this links with metals and power, Saudi Arabia made a noteworthy move on official selling prices for January. The Arab Light OSP to Asia was set at just 60 cents a barrel above the Oman-Dubai benchmark, the lowest official premium in 5 years. That's a signal that Riyadh is responding to rising supply and weakening cash differentials by cutting the posted price to stimulate demand, particularly in China, where independent refiners have fresh import quotas. The move coincides with OPEC Plus continuing to lift output targets. Yet, in practice, actual flows are patchwork because outages and maintenance in a few large producers kept group output below targets in November. For consumers and refiners, lower official prices can spur additional buying, but if production growth across non-OPEC producers continues, it risks a market tilt towards surplus. On dry freight, geopolitical risk is hiking costs in specific lanes. War risk insurance for vessels calling at Black Sea ports has spiked recently, with underwriters reviewing terms daily and war premiums quoted between 0.6 and 1% of vessel value in the immediate period. That's up from earlier levels, and translates into tens of thousands of dollars a day in extra cost for ship owners. For grain markets, that is an added friction. Even when global supplies are abundant, transport and insurance can shift the economic calculus of where cargoes flow. Before we wrap up, a couple of quick takeaways. First, we are watching a theme: plentiful supply in multiple markets with structural transition risks. Whether it's metals fighting for industrial policy to bootstrap local supply chains, natural gas exporters facing margin compression, or grains moving around insurance and logistical bottlenecks, the common thread is that prices are being set not just by physical tons, but by policy, politics, and finance. Second, diversification of outlets. Think Indian steel makers looking beyond Europe ahead of carbon border levies, or Brazilian crushers selling into new routes, will be a recurring response as trade patterns adjust. That's where I'll leave you for today. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, host of the Commodities Institute podcast. Join me tomorrow for another deep dive.